Hello everyone, welcome once again. That's the second episode, if we could call it like that, of the swing trading strategies. Not a lot have been left to be mentioned today. We're gonna see Bollinger Bands today. So and MACD as well. So just a bit of a refresh, a bit of a repetition of what we said yesterday. What is the swing trading? What's the rules we need to follow? And then we can go straight forward to we can go straight to our the strategy that we haven't covered yesterday. Before I do that, as usual, I would like you to let me know if you are facing any kind of issues. Remember that in our chat box, you can ask anything you want. I'm here to help. And if you need anything further, this is the email address, webinars@agfm.com. So feel free to contact us. It will be me, Stuart, or support team that we're gonna reply to your questions. Okay. So before I start, by the way, for those that they have been here with us yesterday as well. Please have in mind that the handout is not the same. So I have updated yesterday's handout. So today's handout, which apparently cannot start, cannot put it on. Why? So I'm gonna upload right now. So give me a second. That's a bit weird. It gives me an error. Let me try once again. So it's yesterday's handout, but plus the few more strategies, the ones that we're gonna cover today actually. So just give me a second. I will try to upload it again. It gives me an error for a reason, but I'm gonna try again. Okay, let me try to upload it again now. Come on. Yeah, it's on. Okay, it's on. Perfect. I have put it on. So you can download from the handout section. Question box is here. Perfect. So we're good to go. I need to go through the disclaimer warning as usual. So guys, we don't. I'm not sure whether we're gonna today's webinar gonna last an hour because I think just 2 strategies left. So I'm gonna try to quickly brief you up again with what we said yesterday, and I'm gonna go straight to the strategy as I already mentioned. So disclaimer, as usual, I need to go through the admin. So this material provides general market communication for information purposes only and does not constitute an independent investment research. Nothing in this communication contains or should be considered as containing an investment advice or an investment recommendation or a solicitation for the purpose of buying or selling of any financial instrument. All information provided is gathered from reputable sources, and any information containing an indication of past performance is not a guarantee or reliable indicator of future performance. Users acknowledge that any investment in leveraged products is characterized by a certain degree of uncertainty, and that any investment of this nature involves a high level of risk, for which the users are solely responsible and liable. We assume no liability for any loss arising from any investment made based on the information provided in this communication. This communication must not be reproduced or further distributed without our prior written permission. Risk warning: trading leverage products such as forex and derivatives may not be suitable for all investors as they carry a high degree of risk to your capital. Please ensure that you fully understand the risks involved. Take into account your investment objectives and level of experience before trading, and if necessary, seek independent advice. Please read the full risk disclosure in our website. So admin is out of the way. I remind you that this is recorded, so you're going to receive the recording as usual. And let's go straight to, so we have seen together liquidity time frame is systematic. We have seen RSI moving average and Fibonacci. We have seen a bit of ATR as well. So today, so I should have updated this slide. So today, as I was saying, we're gonna go through what is key in order to become good swing traders. Okay, we're gonna go through the strategy, swing strategy that in which we use Parabolic SAR and MACD together, and the rules in order to set up this kind of strategy. Multi exponential moving average for creating your own swing trading strategy. And last but not least, Bollinger Bands using Bollinger Bands reminder that in order to apply swing trading strategies, the market, the asset that you will choose needs to be liquid and volatile. So it works best, like every single other strategy or the majority of their strategies, they work best with liquid and volatile markets. And just to remind you that swing trading is a trading strategy that focuses on profiting of changing trends in price action over a relatively short time frame. So swing strategies, swing traders, I typically hold their position from 1 to 6 days the maximum, but they are taking their entry considering any swings, any change of the price intraday or in the daily chart, but most of the times is intraday as well. So the target is to benefit on the price swings, on the change of the price action. Okay, so as I said, typically held for 1 to 6 days, but that's typically the case. There are in some cases you might consider keeping your position for longer if your trade remains profitable. Of course, if you keep losing and losing, don't keep your position open. Okay. So remember, the time frame from this kind of strategies is daily. Okay, it's not a mean reverting. It's not for mean reverting traders or long-term traders. There are people that they might use weekly and monthly chart. We're gonna see that today. But if you are from the people that they use or they like checking the higher time frame in order to get an interpretation of the overall trend, which is brilliant thing to do, have in mind that it's better to be positioned on the side of the trend. Remember, trend is our friend. So daily time frame is the typical time frame of swing traders, but sometimes for taking an entry, we might go down to the 4-hour one or even 1 hour one, just to identify an appropriate entry level. And okay, we have seen this yesterday. Let me quickly go remind you of these 5 steps. 5 is 4 actually, and you repeat them. I would like to get the video of yesterday's webinar. Thanks. Let me check if I can find it right now and distribute it to everyone. You should. So you were in yesterday's webinar as well, or you were an attendee yesterday? Um, because if you were an attendee, it should be on your inbox or in the spam folder sometimes, unfortunately. Here is the link, my dear Anthony. Okay, that's yesterday's one. Yeah, so very simple 4 steps. Actually, there are steps that you might already follow. I mean, this is simple. You need to have a system. You need to trade your system. So remain consistent with your system. Trust your system, and you need to accept your losses, okay, as well, because remember, it's all about risk management. We cannot predict the market, but we can we can do our own risk management, money management, and set some stop losses at the level at which we can accept any kind of losses. Uh, Also, backing up our winners. What I mean by that, locking our profits. This is what I mean by that. It's also good because with this way, if at some point the trend comes against us, we have already locked profits. We are already on profit, so we can partially close the position or completely lock the position. And repeat steps. Have a system, trade your system, so stick on the system, accept your losses, back your winners. I didn't attend yesterday. Can you please forward it? Forward? Yeah, I did forward it to all of you. Have you received it, guys? Walter, Shola, I have forwarded to you. I mean, to everyone. Shola, I need further explanation of Fibonacci. Thanks. Okay, allow me to cover today's strategies first. If there is time at the end, I'm gonna go through Fibonacci as well, okay? But I need to go through today's strategies first. So that's yesterday's, okay? So I will quickly skip all these because we covered them yesterday, and I will go straight to, here we are, to today's slides. Shola, Gabriel, I will explain Fibonacci, don't worry. Just allow me to cover first the new thing, the things that we haven't covered yesterday, and we'll get back to Fibonacci. So, okay, so what makes a good swing trader? So have in mind that successful swing traders are the traders that first of all follows a particular swing strategies. It might not be the ones that I'm presenting that I have presented yesterday and today. They might be their own, okay? But they stick to their strategy and they are looking to capture a chunk of the expected price move and then move on the next opportunity, okay? So try not to complicate stuff. Try to capture to enter the market and open a position, and once that's it's over, then I mean, once you open your position, then move on to the next one. Okay, don't try um, to make it complicated. As I initially said, the key for successful swing trading, and something that is what is key about swing trading, is to make sure that you have picked an asset which is often volatile and liquid, because if there is a lack of liquidity and volatility, then swing strategies are unlikely to work. Okay, it needs to be volatile, it needs to be liquid in order to be able to apply this kind of strategy. So what else I wanted to mention? So it's as we have already stated yesterday, for swing trading we need technical analysis. Okay, so it's a combination of price action, because remember, like yesterday, we are looking the chart, looking whether the asset is above or below moving average and etc., but also checking our indicators. It's a combination of technical analysis setup along with price action observation. Okay, that's why in the most of those strategies we have used simple moving average or exponential moving average and etc. Very important, very important sorry, is to one of the very first steps that you need to do, other than apply your indicators, is to identify the trend, to understand where the market is hitting, to identify the trend, whether it's an uptrend or a downtrend. And it's best, just from a risk management point of view, sorry, yes, Kennedy, they can be applied in stocks, in currencies, and etc. But it doesn't mean, for example, that the Fibonacci strategy that I presented yesterday, it will work good for Nasdaq. Test it before you apply it. But yes, these kind of strategies, they could be applied and they work for any single asset as long as it's volatile and liquid. And stocks, the stocks actually are quite volatile and liquid, especially the US major indices. But apply your strategy on, check a bit, go backwards, check whether it was giving you nice, accurate signals before you actually open a trade. Okay? Because Nasdaq, for example, might be okay with Fibonacci swings, but I don't know, Dow Jones might work better with I don't know, ATR and moving averages, or RSI moving averages, or Parabolic SAR, and you understand what I mean? It's test it first. I mean, check it. Go backwards and check whether it satisfies the asset that you chose. And if it satisfies it, then save it as a template. Save it as a template, and every day, once you open your Nasdaq, for example, your system will be on. You don't need to worry that you need to set it up or check it again and again and again. I have network issues. Can you kindly send me both webinars on my email address? I cannot hear a thing. Okay, Walter, can you download right now the handout, please? The recording, it cannot hear a thing. Can you download the handout, please? Recording will be sent to your inbox. Okay. Ola Sugamni, I have sent the YouTube link if you noticed. I've sent a YouTube link to everyone. So that's the recorded version of yesterday's webinar. Okay. So what makes a good swing trader? Having your system, a combination of price action with technical analysis. Identify the trend is step number 1. Avoid avoid opening positions that they are against the trend. It doesn't mean that you can't do that. You still can open trades against the trend, but you need to be extra careful. If you're about to do something like that, set an appropriate stop loss, set a nearby target, because otherwise you might end up with major losses because you are simply going against the trend. So that means that any kind of pullback or correction is temporary. So, okay. Also, a good trader is the one that can differentiate between a retrace and a reversal. It's very difficult to be spotted, but the people that they manage to understand whether they are facing a retracement or whether they are facing a reversal, a complete reversal, it will be on their benefit. I mean, if they manage to identify a retrace or a reversal. Read candlestick patterns and formation. Remember yesterday I gave an example in which we were using our Fibonacci system, but we also spotted a downwards channel, which is a formation. So if you also combine in your analysis, in your swing strategy, a pattern, a candlestick pattern of formation, that would be brilliant, because that will give you extra confirmation, extra trust on your decision. Don't try to find one. I mean, to find a candlestick pattern, or to find the formation, or to find a downwards channel, or a pennant, or a flag, or a descending triangle. Don't try to find one. If you see it, it's there. If you don't see it, then it's not there. Okay. Walter, the handout is on the GoToWebinar. I mean, it's over there. I have just uploaded it. Not sure what you're saying. Okay, I'm gonna forward again yesterday's video to everyone. Okay, so send it again. Hopefully you receive it. Okay, so let's move on. Have a backtest system that works for you, obviously, your time frame, your personality. What we mean by back test system, simply remember that sorry, give me a second, please. What I mean by backtesting is what I mentioned earlier, that before you apply any of these strategies, test them either on a demo account, either on a live account, but without opening a position. Just go backwards and see what works for the asset that you want to trade. Okay, and in which time frame. Typically, swing strategies are for daily chart, but they can also be applied in a 4-hour chart. Or keep it on a daily chart and have a quick review of the 4-hour chart or 1-hour chart in order to spot your entry point. It's essential to understand the indicators. Okay, the indicators that we have presented. If you don't understand them, don't use them. Set in advance any your risk and reward ratio, because it's very important. It's not only important to set a stop loss, it's important to accept your losses, because if the trade comes against you and it kicks your stop loss, you need to make sure that you are okay with that, the amount that you are gonna lose. It's something that you can control in advance. Remember that we have also um, uh, some calculators online that I presented many times. Okay, in the past, so you can calculate in advance the potential loss or profit that you will have. So you need to make sure that you have chose a risk and reward ratio, a target and a stop loss level for which you are okay with it, for which you feel fine. Okay. Let me just show you something. Yeah, here. Over here, you can add your position, you can add the lot size that you have open, your entry price. Actually, first of all, I have showed them in the past, guys. So, okay, the very first thing, if you cannot do it automatically, if you cannot do it, I mean, just literally on the MT4 and you prefer to manually do it, or not manually actually, by using these calculators, what you can do is to fill this form, okay, add also what percentage of your balance you want to risk on that particular trade. Okay, and over here you're gonna get, so if for example you have $1,000 but you want to open a trade in euro dollar but you want to risk only $100, so put that on and it will give you what should be your lot size. Okay, then you go back to the multi-target calculator, add again whether it will be a long or short position, the lot size that you have previously found, okay, the entry price, the stop price, and your target. If it's one target only, then complete only the very first target. If it's multiple targets, then complete everything and calculate. So over here, you're gonna be able to see what will be your potential profit or loss in dollars. So if you don't feel okay losing, for example, $100, then you can come up here and either deduct the loss size or change your stop loss in order to minimize your potential losses. So you need to decide a loss in which you feel okay. Okay? You cannot predict the market. Some of your trades might end negatively. What is key is you are overall weak to be on profit. Okay, so let's get back. It's risk management after all, okay? Everything has to do with risk management, with sticking to your plan, to your strategy in order to avoid being driven by emotions. And we are done. Let's shift quickly to our strategy. So the third strategy we have seen, is it the third? I've lost track. Yesterday we have seen the simple moving average in combination with RSI. We had seen Fibonacci retracement, and that's pretty much it. Yes, so this is the third indeed. Oops. So now the third swing trading strategy is a combination of Parabolic SAR and MACD. So based on this strategy, if the market is in a downtrend and the Parabolic SAR are forming candles, are pointing to the up, are above the candlesticks, you know, if we're in a downtrend, the Parabolic SAR will automatically form above the candlesticks. So this should give you the heads up that the uptrend may have ended and the market is on the flip side, on the downside. So the market may be now going down. It's the vice versa if we are in an uptrend. in an uptrend, the parabolic SAR are below the candlesticks. I will explain, you will see it in practice, so don't worry about it. Remember that parabolic SAR, right, are good and very, very clear. Actually, it's a very easy way to spot as a market swing. But the negative about parabolic SAR is sometimes are being too aggressive during a trend. I mean, we might get some faulty ones. That's why in this system we use also MACD, because parabolic SAR sometimes are getting too aggressive, so they might give us some mixed signals. That's why it needs to be combined, it must be combined with MACD. If they both agree, then we can take the entry. If not, then it's better to wait. So here are the rules. We're going to show example as well. So you need to apply the parabolic SAR on your chart. You need to apply the default MACD, which is 12.26.9, okay? And wait until you see the signal line of MACD, the histogram of the MACD lines to cross over the signal line. Once you see the MACD lines crossing over, then you can go to your price action and check what the parabolic SAR are pointing. Okay, if the parabolic SAR also switched position, then means that you can place an order, either a buying stop or sell stop order above the high or low of the candlestick at the point where both the MACD and parabolic SAR confirm the entry signal. The stop loss in the meantime should be placed below the low or the high of the candlestick. The target area, the exit of the trade, so the target area could be on the SAR signal. So I will show you an example right now, because this is the only way to make things clear. Okay, so what we have over here? Over here we have the euro dollar daily chart. Okay, that's a 2020 chart, but it doesn't matter. It's daily time frame anyway. It's better to apply the swing strategies in a daily time frame. Okay, so what we have over here, it was in a downwards trend, right? Are you following? It was in a downwards trend. The same stands for MACD. MACD was extending lower. But at some point over here, we have spotted that the lines of MACD cross over the signal line. Signal line is the red line. So over here, we have spotted that the histogram lines went above the signal line. So they were crossing over. So that was the very first signal. Okay? So we put a vertical line, sorry, horizontal, not vertical. No, vertical, yes, a vertical line over here on the swing, on the crossover, up to the price action in order to see where the parabolic SAR are placed. The parabolic SAR are below the price. Does anyone knows what does it means if the parabolic SAR is below the price action? Does anyone knows? Come on, it's easy busy. Buy, uptrend. Correct, everyone. Thank you very much. That's the calculators link, by the way. Yes. So, is our MACD and parabolic SAR presenting? Are they both presenting positive bias buying entry or not? Are they agree or they don't agree? I will wait a bit. Are they in an agreement, in an alignment or not? MACD with parabolic SAR. The signal that we got from a MACD and the signal that we got from the parabolic SAR. Here, don't ignore the rest. Here in the point number 1. No one? Come on, come on, come on. Okay, they both agree. Why? Guys, you told me earlier, parabolic SAR, the fact that parabolic SAR is below the price means a buying signal, an uptrend. The fact that MACD lines increase above the signal lines, it means that the bulls have started to gain the control. There is a decreasing negative bias. It might still be below 0, but you see, it means that the sellers are getting low, are getting fewer and fewer and fewer. I mean, we have an increasing bullish bias and a decreasing bearish bias. So that means that these two indicators, they are pointing to the same signal. They are aligned. Remember, the condition is to wait for a crossover of MACD and also a switch of parabolic SAR. If they both agree, then we can place our order. So in this case, we can place a long position. We can place a long position above the latest high. Okay, but so this is where we pointed the swing of the MACD. Okay, so we can place our long position above this candle. If you were delayed and you didn't spot this swing and you spotted this week later on, I mean, you might saw it 2 days afterwards. So here, let's assume here. Okay, that's still okay. So if you saw it over here, oops, okay, I cannot do a straight line. I guess it's somewhere here. You can place your position, your long position, your entry here above this latest high. So this could be another entry point if you missed that. Okay, you did miss that. You see there is still chance. So you can confirm your entry like that. Where your stop loss will be placed. The stop loss will be placed below the low of the candlestick. So if you have taken your entry here, the stop loss will be slightly below this candle. So this will be your stop loss. If you have entered here, your stop loss will be below our candle. So here, stop loss. Right? Now, your target level it can either be actually based on our strategy, the exit level will be based on the parabolic SAR. As soon as we see the parabolic SAR changing, so from being below the chart going above the chart, above the candles, then this is when you should close your position. This is one way to do it though. Okay, if you have your own risk and reward ratio, maybe 1:2 or 1:3, so you can measure the distance from the entry to the stop and put your stop loss twice this distance if you have 1:2 risk and reward ratio. If you prefer to measure your potential stop in dollars, you say that no, I cannot risk more than $10. So if I risk only $10 in this trade, my stop loss will be somewhere here, so tighter. That's fair enough, but you need to place also your own targets. Okay, that's up to you. If you have your own exit strategy, your own risk management strategy, you can place your target accordingly. But based on the strategy that I'm presenting today, a nice stop loss area will be the low, if you are in a buying position, the low of the candlestick, and an exit level, a target level, could be as soon as parabolic SAR change direction. Okay, remember, do not reverse unless the MACD has reversed. Now, for a short position, the entry will be at the low, below the low of the candlestick, and the stop loss will be above the high of the candlesticks. And an exit will be again as soon as parabolic SAR changes. And MACD uh, and if MACD has reversed as well, that's even better. Now, I have sent you the calculators. Just okay. Now, okay, we have seen a long example. Let's now see a short example. Let me just clear a bit this mess. Erase all. Perfect. Perfect. So now let's see another example, a short example. So MACD was positive over here, but slowly the lines started to dip, to slide, until they came below the signal line. So we have a crossover over here. Okay, perfect. Okay, number 2 was our exit from the previous example, from the long example. Okay, so what I'm showing right now is something different. I'm showing a short opportunity. So over here we have the cross of the signal lines, of the histogram lines below the signal line. So that was the very first signal that the market has changed. It's to the downside. That was the very first sell signal. But we need to confirm it, remember? So we need to confirm. So we need to go up and see the price action and whether the parabolic SAR are below the price or above the price. So indeed, over here, the parabolic SAR were above the price. So that was coming in alignment with the MACD. So they both were suggesting a sell position. So you could either, if you have spotted it over here, then you could, so on this candle, you could take a short position, okay, below the low level of this candle. So that would be the entry, and the stop above it. That would be the stop. The target, the exit level could be as soon as either parabolic SAR reverts. Okay, in this case, parabolic SARs reverted over here, which is, it led me to a break even. Or as soon as you decide to close the position because you had two bullish candles, support area over here. So you need to judge yourself. You need to judge what you see, okay? Because if I was waiting for parabolic SAR to switch, I would have ended break even, which is not bad, okay? At least it is not a loss, but there were signs about the rebound over here because it found support, too long legs to the upside, so implying that this is a rebound, this is a trend reversal. So erase all again. Excuse me. Okay. Now, why? Okay. So another possible entry will have been um, actually. So so another possible entry will have been this one, right? Over here. So parabolic SAR turn below the price action. MACD over here change as well, as you can see. And actually not only we have a crossover, but we have a change from negative to positive. So that had, it was also an entry signal for going long. I put some X's over here. Why? Because I want to show you what to avoid. So what to avoid is your parabolic SAR or your price action to come in contrast with your indicator. Over here, for example, okay, over here, the histogram lines were below the signal line, so there wasn't um, uh, any crossover. Okay, there wasn't. It was pretty much more of a sell-off, more of a negative bias. At the same time, parabolic SAR, it was indeed showing similar conditions, so pressure, sell-off for the asset, until it's at some point it turned. But during the time that the parabolic SAR turned bullish, MACD line, MACD line was also provided some crossover, which it didn't lasted. So what you need to be careful about? Be careful on if you decide to take this kind of entry, be careful of on the timing and on the exit level, because you see this was a short live reversal, short live. Actually, can you see that? Okay, here it is. Now it will be clearer. Okay, parabolic SAR was down. Okay, down, 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 but it remained above the price, even though the asset was moving higher. So that's misleading. Since the market was moving higher, parabolic SAR should have come here. Okay, so if you have this kind of misleading signals, don't take the entry. Also here, it was down, but instead we could see the parabolic SAR being below the price. Again, misleading. For having a bearish market, for having a sell-off, and since the candles were pushing the price lower and lower and lower, parabolic SAR should have been here, above the price, not below the price. So that's a misleading signal, despite the fact that parabolic SAR over here and MACD, they agree. The parabolic SAR shouldn't be on this direction, should be on the opposite direction based on the price action. So be careful with this kind of misleading formations. Okay? Are you with me? Yes, they are. Can I be used on the 1 hour? Test it, because before you you use it, Shola, Gabriel. These swing tradings are preferably used and typically used in a daily time frame, but for some assets they do work in 1 hour and 4 hour one. So test it, okay? So you see, very, very careful. I want you, once we are done our webinar, to pay an extra attention on these cases over here in which we had misleading parabolic SAR. And what I mean by misleading is that the market was started moving higher, but parabolic SAR remained above the price. Then the market started moving down, but parabolic SAR were up below the price. So that's wrong. Okay. Yes, you can, Walter. Yes, you can. But test which one of all these strategies that I have shown yesterday and today, it works better for Nasdaq. Okay, for daily Nasdaq. So is the swing strategy which combines MACD and parabolic SAR clear to you so far? Shall we move on to the next one? I will wait a bit for your replies. If you're not confident with it, I want to know it. I want to make sure that you do understand. Clear on my side. Thank you, Walter. Actually, I had more examples. So another example, dollar CAD. So you see, different assets. Dollar CAD daily. So, so over here, we decided not to take the entry because it was a bit misleading. The asset was in an uptrend up here, but then started posting lower lows and lower highs. But parabolic SAR didn't shift, didn't turn. So that was next. Then it finally went above the price, suggesting a selling signal. The same stands for MACD. You see, extending lower, so that was a nice entry. Then we have a crossover over here. So that was in line with the parabolic SAR. Cool. Further crossovers, so the crossover continue and the MACD lines continue to increase above the signal line. But they weren't in agreement with the parabolic SAR until here. So the alignment came here. Okay, so that's another entry opportunity. You could have entered from here as well, but you could add on your position here as well. Okay, if you decided to enter long here because of the crossover of MACD along with the parabolic SAR pointing to the upside, that's fair enough. That's a yes. But afterwards, that we had an even more aggressive rally, you could add on your position. So how can a cross, sorry, I wasn't clear. You're right, Gabriel. Cross in what sense? Is this when we see after some time because we could see the lines crossing either above or below the signal line, the red line. Okay, this is what we mean crossover. I mean, if the lines are crossing below the signal line and while the MACD is in a negative territory, that's a selling signal. Does this selling signal over here agrees with parabolic SAR? Yes, it agrees. So we are good to go. Over here, we had another change of MACD and signal line. The MACD lines started moving above. See, they started moving above the signal line. So they flipped to the upside. They were below the signal line and then afterwards they went above the signal line. So on this very first primary signal, which is a buying signal, does the price action and the parabolic SAR agree? Parabolic SAR over here agreed, but the price action was a bit sideways. So it was a bit of a question mark whether it's a good time to enter or not. The confirmation for a buying signal came over here. So as soon here. to be more precise. When the parabolic SAR turn again below the price, which is a buying signal, and at the same time, the market broken this ranging market. Can you see that? Yet be, I cannot really tell. You have 200 bucks and you want to use this in the 1 hour time frame. You can, okay? It doesn't mean that you can. Yes, you can, but test it first in a demo account. Again, I'm telling you guys, swing tradings are preferable to be used in a daily time frame, not intraday ones. They might work for intraday time frames for 1 hour and 4 hour, not less than that, but it doesn't mean that I cannot confirm that they will work. You need to, for example, at Oyebi, if you are trading gold, go to your 1 hour chart, apply them on in your demo account preferably, and check whether it gives you correct signals and good signals, etc., etc. Test it. If it works, keep it. But since you have only 200 bucks on your account, use your demo account for applying these indicators and this strategy. Check if it works, and then go live. Is the dotted line on the chart shows the cross? Gabriel, the dotted line, sorry, yes, it's the dotted line, the red line in MACD is called signal line. The dotted line on the chart is the parabolic SAR. Okay. By saying crossover, we're referring to the changes in MACD. Changes like that when the gray lines with that, which are the histogram lines, turn above the signal line, or that the lines turn below the signal line. But here, these are crossovers. These are crossovers. Crossover again. Okay. So if we had entered long, let's say here, because parabolic SAR was below the price action, so that was a buying signal, and also it came in agreement with the bullish crossover of MACD lines above the signal line. So if we had entered here long, an exit level will be either here when the parabolics are changed, okay, or you see the parabolics are changed, but MACD was still positive. So we could do a partial close over here. But the full close will have been over here when the parabolics are started to be negative, and at the same time MACD also started to point to a reversal. So that should be our exit trade. Okay? Or this one. So let's check the fourth swing trading strategy. Multiple example moving exponential moving average. So we use 3 moving average, 3, 5, and 21. It's pretty easy, something that we have covered in the past. So it's when you have a crossing of this moving average. So okay, let's go directly to the chart. Oops. So here's the chart. So we have 3 exponential moving averages on. Okay, we have 3, 5, and 21. This is a strategy that you can use in the 1 hour and 4 hour charts as well. But again, test it. Every single asset needs a different treatment. So we have 5, which is in 5 exponential moving average in red. 3 exponential moving average in a red line, 5 exponential moving average with a blue line, and 21, which is a 28 one exponential moving average in a yellow line. So this swing strategy suggests that you can go long when you can go long when your price action is above the 21 exponential moving average. Okay, and you can go short when your price is below the 21 moving average. So you can enter the market by checking the 21 EMA. If the price is above, it closed above the 21 exponential moving average, like here, you can enter long. If it has closed below your 21 moving average, like here, you can enter the market short. Okay, now I have shown you when to enter the market. Now it's time to show you how to exit the market. For example, over here, we said that if our price closed the candle, it's a daily candle, so we need to wait to see this closure. As soon as we see the asset closing the day above the 21 moving average, the very next day, or we can place a pending order, we can place a long position, right? But when shall we close this long position? When shall we exit our long trade? You will close your position as soon as you see your moving average, the other two, okay, the 3 and the 5 moving average, just how we call it, so when you see 3, 5 crossing, so over here when we enter long, they were both of them were pointing higher, right, with 3 being above the 5, but over here the 3 came below the 5, so that was a sign that the bullish market turned into a bearish market and it's time to exit. So that was the exit level. As soon as you see the 3 crossing below the 5, that is in case that you are in a long position. If you are in a short position and you have taken an entry once the market closed below the 21 moving average, then you can exit the market as soon as you see 3 exponential moving average crossing above the 5. And that happened over here. That was the exit level. Okay, this is it. This is it pretty much. Okay, I mean, it's quite straightforward, I think. Sometimes it might lack, like in this case over here. So the candle closed above the 21, so that was an entry point. But 1, 2, 3, 4 candles afterwards, it was when we have spotted the exit level. So we will have end up in loss. But it is lagging. But as you can see, most of the time, it does work brilliantly. Okay, so if we have taken all these entries are one long, one short, one long, one short, one, what's that? That's a short one again. So 1, 2, 3, 4, 5, 5, 6, 7, perfect, 7, 8, 8, and another one 9, 9 over here. So if we have taken all these entries, there are 9 entries, we would have failed only. Let me just clear a bit this mess. We would have failed only, come on, in this one, and in this one. So 2 out of 9 will have ended in loss, but all the rest, so 7 out of 9 will be in profit. So you see that the chances are on your favor. When to close a position? You're closing the position. So you are entering the position based on the 21 moving average, right? Okay. You are exiting the position on the cross of 5 exponential moving average and 5 exponential moving average. So, I mean, this is over here. So I have entered long because the market closed above my 21 moving average, right? So here is my entry point. My exit point is as soon as we see 3 and 5. Can you see that the red line is the 3 exponential moving average cross below the 5 moving average? So that is our exit level. Okay, the exit level will be on the cross of the 3 below the 5 if we're in a long position. If we are in a short position, the exit will be as soon as we see the 3 exponential moving average above the 5. Is that clear, guys? I will wait a bit for your answer. Cool. It's the steps are here, the rules are here, so don't worry about it. So it's clearly stated over here. You're gonna take a long position if your asset is above 21 EMAs. If it closes above 21 EMA, you're gonna go short when it closes below the 21. You're gonna go exit. Okay, it's not so clear over here. As soon as you see 3 crossing 5, okay. Yes, when the 3 moves below, it should be over here, below the 5, okay, in a long position, or if the 3 moves above the 5 if you are in a short position. If it also crosses 21, that's even better. But it doesn't mean that you will always see crossing 21 as well, okay? What I mean, over here, so here was another exit point, but you see it was a bit delayed. That's why, so over here we had 3 and 5 crossing below 21, but it was a bit late because that means that we will have benefited only this much. But if you had closed your position over here on the very initial crossing, then you will have benefited all this, okay? 3 above 5, close for sell. Yes. 3 below 5, close for long. Okay, Gabriel? Yeah, so this is another one. Okay. Okay, so the asset turned below the 21. 21 is the purple one, okay, the pink, whatever. So it turned below. The price was below the 21, so we could enter short, okay, and we had the crossing of 3 and 5 over here, so we will have benefit around this much. Okay, obviously if you wish to exit earlier, that's fair enough. If not, then leave the stick on the system. I mean, you could also have taken an exit as soon as you see this bullish candle. It was up to your decision. But for me, because I prefer to remain a bit calm, not to check the markets every single hour, I prefer to wait. I mean, to stick on my signal, but that's up to you. Over here, so the asset remain below the 21 moving average, but until it eventually decline again. Okay, so you can combine stuff over here because it continued extending lower, so it wasn't able to move above the moving average, right? The 21 moving average. So it continue turning lower until eventually broke that support level with a big sell-off. So what we have over here, three criteria over here. The asset is below all moving average, 3, 5, and 21, broken this support line. So that was another selling signal. Okay, and as soon as 3 crosses above 5, we could see our exit signal. Okay, last but not least, let's move on to Bollinger Bands. Bollinger Bands, remember, is a continuation trade. It's been used for continuation trade. It's a continuation trading strategy. So we're gonna use the default settings of Bollingers, okay? And the strategy. So focus on this part of the slide. If we're gonna use for swing trading Bollinger Bands, we need to monitor the Bollinger Band lines. So we need to first of all identify the trend, whether we are in an uptrend or a downtrend, then define whether the price is above the midline of the Bollingers. Remember, the midline of the Bollingers is the 20 period moving average. So whether it's above or below it, okay, or whether it's touching a band, the upper band or the lower band. Because every time that it touches a band, it means that they will return to the moving average. And every time it breaks the midline, it means that it will retest the other side of the band. So I'm going to explain right now, okay? Without the diagram, it's a bit... So these are the rules, the entry rules. If the price is moving below the midline of the Bollinger, then this is a possible sell entry because the market is downtrend. But how we can be sure? We need to use the angle of the simple moving average to indicate how strong the trend is. If the simple moving average, the angle of the simple moving average is aggressively down, I mean, so remember, it's an angle over here. If it's like that, it means like it's a bit narrow. If it's 45 degrees, for example, it's sharp. Okay, so by observing a bit the angle of the moving average, we can see the power of the trend. And then we will decide whether we can whether we will go long or short. If the price is below the moving average, that is a sell signal. If it's above the moving average, that's a buying signal. We need to see price moving above the middle line. Okay. If we see the price moving in that direction, that it might means that it is likely to retest its upper Bollinger Band. If it's moving below the middle line, then it might retest the lower Bollinger Band line. Now, if it's in the lower Bollinger Band line, so where is it? If it's yes, If it's the lower Bollinger Band line, so let me show you in practice. Okay, let me show you in practice and you can read the charts afterwards. Okay, we're gonna come back to the exit rules soonish. So here is euro using Bollinger Bands. Okay, remember, every time that the price is breaking the 20-day moving average, this blue line in the middle, this suggests that it is likely to touch the upper line of the Bollingers. Every time that that it touches the Bollinger Band line, if it has touched the upper Bollinger, it means that eventually it will return back to the middle line again. If it fails to break below the 20-day moving average, then it means that as soon as it found support, it could rebound. This is what happened here and retest again the upper Bollinger. So how we treat this kind of what steps we're following. So first of all, you need to check whether the price is below or above the middle line. In this case, it was above it until it eventually broke it. Okay, so that could be an entry point with target the upper Bollinger Band. If you haven't seen that, that's fair enough, because we had a second buying signal over here. Why is that? Because it came aggressively down, it retested the signal line, but it didn't manage to break it. So it was a very first sign that it might rebound. And the second day, it posted a bullish candle. So that was another sign that it found support and it could rebound and retest again the upper Bollinger Band line. So you could have entered long here as well. Okay. Now, when should we exit the long position? We can exit the long position as soon as we see the asset touching or even breaking the Bollinger Band line. So that would be our take profit. Okay. Now, so what else? So, okay, over here, we could see a bit of a consolidation, a bit of indecision. It was overbought and it started moving sideways as a correction, but we had seen also a long leg upwards. Okay, so that's a note. That's a question mark. So we're like thinking, okay, is it a correction? Is it a reversal sign? Who knows? Okay, but that fully body bearish candle came, indicating that the asset will move down. So there was a selling entry with target at the moving average, at the 20 moving average. And stop loss, you can use a stop loss the pitching of Bollinger Bands. So you can use this latest high. You see this candle breach up here. So you can use this as your trailing stop loss. Okay, so you can enter short, trailing stop loss up here, and target and the exit level will be as soon as it touches the 20-day moving average. Okay. Okay, another buying signal is this one. Why? You can say, but Andrea, these are doji candles. Why? Because down, retested 20, didn't manage to continue moving downwards. The next day was bullish, okay, holding above that, so it closed above the 20 moving average. The very next day it was doji, but still holding above the 20-day moving average. And the third day it crossed, breaking this resistance area, this immediate resistance area, and holding this support, which if you connect the lows, they're like increasing. Okay, I cannot do a straight line, but you can see that is we get higher lows, higher highs along with the breakout of this latest resistance, and at the same time it found support close to the 20-day moving average. So that was another buying entry. If you weren't sure whether it's a good time to enter long here, you could wait for further confirmation. So further confirmation came here. So this could have been a nice entry because it broken the resistance of the past 4 sessions, 4 days. So that could be another entry point. With exit, um, um, so with exit, either once it breaks the upper Bollingers, okay, or until it hits your trailing stop. That's why I'm saying over here, do not exit here. Why? Because if you have put a trailing stop, okay, below the latest low, so if you have entered here and you have put a trailing stop here, then that means that your trailing stop will move along with your um, with your candle, right? So it will be here, and it should close somewhere here, I think, or somewhere. I cannot estimate. It should be close somewhere here because the trailing stop will move up as the price moves up. So here the price stopped moving up. So the trailing stop should have freeze. So and then it kicked down, and it should somewhere here it should close automatically. Okay. So either you can exit as soon as it touches or breaks above your upper Bollinger, or use your stop loss, and your stop loss will automatically close this. It will automatically close the position for you. Yeah, so that's pretty much it, guys. So as I'm saying over here, oops. No, here, exit rules. You can either use the band as your exit. You can use because the bands can be used as your target levels, or you can use also, don't forget that it's better to use trailing stop as well. Similar to what we see yesterday, you can use trailing stop of either placing your stop loss either at the lower low of the last 2 or the last 5 period if you are in a long position, or if you are in a short position, place your trailing stop to on the highest high of the last 2 or the last 5 candles. If you see a pitch, that means that there is a lot of volatility and a lot of indecision as well in the market. So wait until you have further confirmation, like in the example that we've seen over here. So we have a big pitch and it was moving a bit sideways. I mean, it wasn't clear, okay? It became clear as soon as we saw this bearish candle. That was a short position with trailing stop up to here or either here, okay? And I need to go through Fibonacci because someone asked for it at the beginning of this webinar. So Fibonacci is a bit straightforward, actually straightforward. You need to make sure that you have a long trend, okay? Your asset has been in a very long-term trend. So once you spot a downtrend, not a downtrend, sorry, a reversal of the overall trend. So over here, we had been in an uptrend for nearly 3 months, okay, until it topped over here. So we have placed our Fibonacci. At some point, the market started to move lower and lower and lower and lower until it bottom over here. It bottom close to the 50% of our previous Fibonacci. Okay, so that was a sign that they found some support. So is it gonna extend losses or is it ready to rebound? That was the question. As soon as you see the market bouncing back and breaking your Fibonacci retracements. So here it was a nice entry point because we have seen this support over here, a nice strong support, and 2 strong bullish candles that turned the price action above the 23.6 Fibonacci level of the new Fibonacci and the 38.2 of our previous Fibonacci. So that would be a nice long position with targets at the 50 and 61 Fibonacci levels. Okay, as soon as we see a retracement, so the asset over here struggling to break and move above 61 and to regain this top. So we have some retracement over here. So we need to wait and see whether a new downtrend is about to start. So sideways for 1, 2, 3, 4 days in a row. Then the next day was another negative one. So 1 negative, 2 negatives, 3 negatives, and a significant breakout of 31.2. So we can enter short with target at the 23.6 or 23.6 or 31.2 Fibonacci level. Or if that breaks, we could add as a new target this one. I mean, Fibonacci is a bit straightforward, to be honest. It's like you usually use your Fibonaccis here as well. So we had been, we had been, sorry, I ran out of steam. We had been in an uptrend, right? So that's why we have placed the Fibonacci from here to here. We had placed another Fibonacci from here to here. Why is that? Because we are in an uptrend, we had a bit of a correction, and we had a new up leg. So we have put 2 Fibonaccis. Right now over here, we've seen that it's struggling to move further to the upside, and we are getting some consecutive bearish candles. So the asset came back to 38.2 Fibonacci and is retesting it. If it breaks it, then we can enter short with targets after 50 and 61 and the previous 50 as our potential targets, you see? So you can risk 50% of your position here, another, I don't know, 30% here, and the rest of the 20% on the target number 3. Okay, it's easy busy. So I'm gonna call it a day. It's already 30 past 3. So let me just, okay, let's see Bollingers. Any questions? I'm here to help anyway, guys. Remember, swing trading is very different than day trading. It works good in a daily time frame. It can be applied in a 4-hour chart and a 1-hour chart as well, but test it. It's very crucial to test it because every single asset is different. Some are more volatile than others, some are more liquid than others. So this kind of trading will not, it cannot be applied in a non-liquid market or a very, in a lack of volatility. Have your system, trade your system, test your system, accept your losses. Risk management is essential, like every single for every single strategy, that this is a swing strategy or not. It's very important to stick on the system and to do your own risk management. If you don't want to follow the exit levels that we presented today and yesterday, it's fair enough, but you need to have an exit level. You need to have your exit system. Okay, so are you going to present any intraday strategy? I have done it in the past, dear Doyebi. Can you visit our past webinar website, and we'll have plenty of those. I don't remember then what else we are presenting this month, and whether we included any intraday strategies. But let me check actually. Let me check. Education webinars. So we have some advanced trading strategies with Auto using price action and mean reversal. We have algorithmic systemic trading from Stewart as well, which is it works for intraday and medium term and long term time frames as well, and a position trading from Auto. So yeah, there are plenty this month, but anyway, we have past webinars as well, so you can have a look on our past webinars as well. Someone asked me how to set parabolic SAR. Sorry, I missed this question. So where is it? Okay, it should be there. Even if you're using MT4 or you're using MT5, in both platforms, it should be below the trend indicators folder. Okay, trend indicators folder. Parabolic SAR is over here. Okay, over here, below the trend indicators. So I'm gonna call it a date. Thank you very much for being here, for paying attention. Hopefully it was an interesting session. If you face any problem, if you're struggling to understand, if anything you need, just send me a message at webinars@hfm.com. Okay, email me. Thank you very much. Have a great day ahead, and see you again tomorrow in a live analysis session in YouTube and Facebook. Thank you very much. Have a great day ahead. Take care. Bye-bye.